and value stock screener. Now, what are the metrics that we have used here? Number 1, EPS growth 3 years more than 5% and average return on equity for 5 years more than 10% and return on invested capital more than 10% and return on assets for 5 years more than 10% and earnings yield for more than 10% and price to earning less than 10 times and price to book value less than 5 times and EV by EBITDA, enterprise value by EBITDA, earnings before interest, tax, depreciation and amortization is more than 5 times and debt to equity less than 5 times and Petroski score is more than 6, which is considered to be good, and book value in the preceding year should be more than 100, indicating a size of the company, size of the total assets of the company, which are supposed to be good. Now, let us see the explanation why and what exactly does each of these metrics will do for us. Number 1, EPS growth 3 years more than 5%. This criteria ensures that the company has achieved consistent earnings growth over the past 3 years, indicating strong performance and potential for future growth. Second, average return on equity for 5 years is more than 10%. A high ROE over the past 5 years consistently demonstrates the company's ability to generate profit from shareholders' equity, reflecting efficient management and profitability. Third is return on invested capital, ROIC, more than 10%. ROIC measures how well a company generates returns from its capital investments, ensuring that the company is efficiently using its capital to generate profits. Fourth point, return on assets for 5 years is more than 10%. A high ROA over the past 5 years indicates the company is effective in using its asset to generate earnings, showcasing operational efficiency. Number 5, earnings yield more than 10%. This criteria assesses the earnings generated by each dollar, each rupee invested in the company, providing a measure of profitability and valuation attractiveness. Price to earning less than 10 times. A lower PE ratio indicates that the stock is undervalued relative to its earnings, making it a potentially attractive stock for value investors. Next is price to book value less than 5. This ratio compares the market value of the stock to its book value, ensuring that the stock is not excessively overvalued compared to its actual assets. EV by EBITDA less than 5 times. This ratio measures the company's enterprise value relative to its earnings. It is more than 5. EV by EBITDA is more than 5 times. Before interest, taxes, depreciation and amortization, ensuring that the company is not undervalued relative to its earnings. Debt to equity is less than 5. A lower debt to equity ratio indicates that the company has a manageable level of debt compared to its equity, reducing the financial risk. Petroski score more than 6. The Petroski score is a measure of the company's financial health, with a score above 6 indicating a strong financial position and potential for growth. Next is book value preceding year more than 100, ensuring that the company has a substantial book value from the previous year, indicating a solid asset base and financial stability. Now, what is the overall effect of this particular screen? This screener combines both growth and value matrices to filter out companies that not only have demonstrated strong financial performance and growth over recent years, but also are currently undervalued or fairly valued in the market. By focusing on a mix of profitability, efficiency, valuation, and financial health metrics, the screener aims to identify robust investment opportunities that offer a balance of growth potential and value, appealing to both growth and value investors. Let us first understand what are all the different ratios that are available for making up a screener. Let us start from items that are recent in origin. That means those which utilize recent data to calculate ratios. First one is market capitalization. This indicates the company's size and its market value. The bigger the better. Next is price to earning ratio, PE ratio. It evaluates the company's current share price relative to its earnings per share. This actually indicates how costly or how affordable is a particular share to purchase. Next is the price to book value. It compares the market value of a company's stock with its book value. It indicates what is the inner worth of the company that you are buying for the money that you are paying. That is value for the cost. Next is return on assets. It measures how efficiently a company uses its assets to generate profit. The higher the better. Debt equity ratio assesses the company's financial leverage and risk. There are two types of looking at it. If you are sure of getting your money back in the shortest possible time and your product is top of the line, a higher debt equity will give you more return for the interest that you pay for your debt. But if you have a new product or a product that is entering the market newly, you are not sure how it will be taken up by the market, then the lesser the debt to equity is the better. And normally banks look for less than 3 ratio. Next is return on equity, ROE. It indicates the profitability relative to shareholders' equity. Next is earnings yield. It is the inverse of the PE ratio. It provides a yield based on earnings. Especially it is relevant when you are buying a share at a higher market value compared to its face value of the share. Next is enterprise value. It considers the total value of the company including debt and equity. Then Petrosky score. It is a score based on 9 criteria to assess the strength of a company's financial position. Return on invested capital. It measures the return generated on capital invested in the business. Earnings per share growth. It reflects the company's profitability and growth over time. Next are the ratios that relate to the preceding data, the preceding year data, comparative data and things like that. Data. Ratios based on the preceding year to just see the growth. First was the book value of the preceding year. It shows the company's net asset value from the previous year. It will be good to compare how we have grown over 1 year. Next is return on capital employed preceding year, ROCE, indicates the efficiency and profitability of the company's capital investments. Return on assets preceding year, ROA, past performance metric for asset efficiency. And return on equity preceding year, ROE, past performance metric for shareholders' profitability. This is the preceding year. That will be beneficial to see how consistent is a company's performance. Number 1, average return on equity for 5 years reflects the company's historical profitability for the period of 5 years. Next is average return on equity 3 years. It indicates more recent historical profitability, that is medium term. Book value 3 years back. It provides historical perspective on the company's net asset value. Average return on capital employed for 5 years. It is historical metric for assessing the efficiency of capital use. Average return on capital employed 3 years is more recent historical efficiency of capital use. Average return on equity 10 years, long-term historical profitability indicator. Average return on equity for 7 years, long-term profitability over a mid-range period. Return on equity 5 years growth shows growth in profitability over 5 years. Historical PE for 3 years provides context for the company's PE ratio over the medium term. Historical PE for 5 years gives a longer term perspective on the PE ratio. The focus areas will be 4. Number 1, growth potential. Here you emphasize on EPS growth, return on equity and return on invested capital, ROIC. The next one will be profitability. Profitability, the focus will be metrics based on return on assets, return on equity and earnings yield. The third is the valuation. You have to consider price by earnings, price by book value and enterprise value. And the financial health in general, you have to take a look at the debt to equity, Petrosky score and book value. These are the 4 focus areas where if you take these metrics, you will be able to arrive at a proper screener.